Consumer sentiment just hit the lowest level on record. Confidence is collapsing, spending power is weakening, and uncertainty is rising across the entire economy. But at the exact same time, crypto is expanding into banks, countries, and entire financial systems worldwide. So what's really going on here? Why is crypto growing while the consumer is breaking? And more importantly, what does that tell us about where capital is going next? This content is for informational and educational purposes only. Nothing in this video is financial advice. Markets are volatile, narratives shift quickly, and you should always do your own research before making any decisions. Welcome back to Ledger Pulse, where we break down the signals that actually matter. Not the noise, not the hype, but the underlying moves shaping where this market is going next. If that's what you're here for, make sure you're subscribed, because you're in the right place. So let's get into it. We need to start with macro, because everything flows from here. According to CoinDesk, U.S. consumer sentiment just dropped to the lowest level ever recorded. The University of Michigan Index is now at levels not seen since 1978. That means confidence today is lower than the dot-com crash, the 2008 financial crisis, even pandemic-era uncertainty. And when consumers feel like this, three things happen. They stop spending, they increase savings, if they can, and they pull back from risk. That's the traditional expectation. But here's the disconnect. Because historically, when consumers weaken, risk assets should struggle. And yet, crypto isn't shrinking, it's expanding. This is where most people get it wrong. They assume weak economy equals weak crypto. But that only applies if crypto is purely speculative. If crypto is becoming infrastructure, then weakness in the traditional system can actually accelerate its growth. And that's exactly what we're starting to see. While retail confidence is collapsing, institutions are quietly positioning. Again, via CoinDesk, nearly 80% of Japanese institutional investors plan to allocate to crypto within 3 years. Let's pause on that. This isn't retail speculation. This is pension funds, asset managers, long-term capital allocators, and they're not chasing hype. They're preparing for structural change, because institutions don't wait for the narrative to be obvious. They move before it becomes consensus. Now we move from positioning to implementation. SBI Remit is expanding with Ripple and Totori Bank. Focus areas, remittances, and salary payments for foreign workers. This matters more than it seems, because remittances are one of the largest global financial flows. And historically, they're slow, they're expensive, and they rely on legacy systems. So when Ripple integrates here, it's not just a partnership, it's a replacement layer. Now let's talk about the bigger shift. OneChain adds support for Ripple's RLUSD stablecoin, enabling transfers across the XRP ledger, Ethereum, Cardano, and OneChain. This is one of the most important developments in the entire episode, because for years, crypto has had a major problem: fragmentation. Different chains, different ecosystems, different liquidity pools. But now, we're seeing the early stages of unification. And once liquidity becomes mobile across chains, that's when real efficiency begins. That's when capital flows faster, systems integrate, and global usage scales. This is infrastructure being built in real time. Now let's zoom out again. Stablecoins are showing up everywhere. In the UK, Coinbase expands GBP-backed stablecoin access. The UK is actively integrating stablecoins into finance. At the same time, Red.Pay enables payments across 100+ countries. This is a massive shift, because stablecoins are doing something Bitcoin never fully solved. They're integrating directly into payment systems, not just as assets, but as money. Distribution is the real game. Technology alone doesn't drive adoption, distribution does. And this is where things get serious. We see MoneyGram and Stellar coming together, expanding global reach, nearly 500,000 retail locations. That's not crypto native. That's real-world infrastructure. This means cash to crypto, crypto to cash, anywhere in the world. This is how adoption actually happens, not through speculation, but through accessibility. Now let's talk about global inclusion. Here we see from CoinMarketCap, PUSD stablecoin, 2.3 billion circulating, expanding into 3 trillion Islamic finance market. This is huge, because crypto isn't forcing a single system, it's adapting to multiple systems, and that's how you scale globally. Now, Europe adds another layer. Over 1 in 3 investors would switch banks for crypto access. That changes everything, because now, demand isn't top-down, it's bottom-up. Banks don't lead this shift, they respond to it. Here, we see Thailand is now considering allowing crypto derivatives inside existing financial systems. This reduces friction dramatically, and more importantly, it signals acceptance, not resistance. And finally, Singapore's OCBC launches GoldX, tokenized gold, on Ethereum and Solana. This is the endgame, because once real-world assets go on-chain, crypto stops being a niche market and becomes the financial system itself. So step back and look at the full picture. Consumers are weakening, pulling back, and losing confidence. But crypto is expanding globally, integrating into banks, powering payments, connecting systems, and moving real-world assets. This isn't contradiction, it's transition. Capital doesn't disappear, it relocates, and right now, it's moving into infrastructure. Now I want your take, and actually think about this. What matters more right now? A, macro weakness, B, crypto expansion, or C, regulation catching up? Drop A, B, or C in the comments, and tell me why. If you want to understand what's happening further in crypto, check out these videos here. They break down how capital rotates during these moments, and what historically comes next. If you like this breakdown, be sure to hit the like button. Thanks for listening, and we'll catch you on the next one.